It's almost time for another inflation number. Tomorrow morning at 8:30, the Bureau of Labor Statistics is going to release their monthly Consumer Price Index, or CPI, which is the most widely publicized measure of inflation. And if you turn on any mainstream financial press right now, it's a regular Peking buffet.
Inflation has peaked.
We're right around peak inflation.
Inflation could soon peak.
We're at peak inflation.
Inflation's peaking. Peaking inflation.
So what gives? Has inflation peaked? Well, let's look at the numbers and see if there's any truth to this. Now, first of all, I got to clarify a couple of things. Inflation coming down does not mean prices coming down, okay? That's an important distinction. Inflation is a rate of change. Any CPI number that is positive means prices are still going up. Now, if we get a CPI reading that comes in lower than last month, that would mean prices are still going up. Prices are just going up slower than they did last month. Another thing I want to draw a distinction between is inflation and core inflation. Now, the talking heads in the press like to talk about core inflation because it removes volatile things like food and energy from the equation, and it just looks at everything else. Well, food and energy are actually some of the most inflationary categories right now. So I've been talking about on this channel for a while now how I expect this bifurcation in the inflation statistics where core inflation may actually come down even though headline inflation stays high because people are spending more of their income on food and energy and housing, and there's less money left over to buy anything else. So that might mean the prices of things like vacation and TVs and luxury goods is coming down, not because the inflation problem is getting better, but because the inflation in the more vital areas of the economy are so bad that people just can't afford to buy any of those things. And there's a couple of recent headlines that support this, and we're going to shrink my big melon of a head and look at some of these headlines. First of all, retail markdowns could be coming as companies tackle excess inventory. We saw this in Target earnings and Walmart earnings. A lot of the retailers have all of this inventory because they ordered too much stuff when the supply chain was up in the air and we didn't really know what was going on with the lockdowns in China. Now all that inventory is here. Consumers have no money left over after food and fuel to buy any of this stuff, so there's big markdowns on the horizon. We may see something like this start to show up in this CPI report. Another thing that indicates this bifurcation in the inflation numbers is durable goods orders coming in less than expected in April. Right? Durable goods is anything that's expected to last more than a couple of years. Blenders, TVs, toasters, cars, you name it. And on top of the lousy durable goods read, we also got the Philly Fed's manufacturing gauge drop to its lowest level in 2 years. That means they're building less stuff. The manufacturers are having a hard time profitably building things. This could be another indicator that this bifurcation in the inflation is starting to hit as people have less money for manufactured goods because they're spending everything they have on food and energy. Now, with that out of the way, let's revisit the CPI numbers from last month. And here we can see the year-over-year number came in for all items at 8.3%. That was the headline number. And then down here, all items less food and energy, which is your core inflation number, that came in at 6.2%. Some of the heavy hitters last month was food came in at 0.9 month over month and 9.4% year over year. Energy was the big hitter last month at 30.3% year over year. But remember, we actually had a slightly negative month over month number for the April statistics because we had that huge spike in March with the invasion of Ukraine that came back down to earth last month. Two other categories that have had a huge impact on inflation recently have also been new and used cars. New cars came in at 13.2% year over year in April with a 1.1% month over month increase. Used cars came in at a whopping 22.7% year over year, even though that was a negative 0.4% increase. So let's take a look at these categories, what they did in the month of May, so maybe we can get an idea of where CPI comes in tomorrow morning. First, let's talk about food. We've been talking about food price hikes a lot on this channel and about pending food shortages. What we're looking at right now is the UN FAO, or Food and Agricultural Organization. This is the global average for food prices that the UN publishes. And what we're looking at here is the trend in food prices globally over the course of several years. Now, the red line here, this represents 2022 prices, and the orange line represents 2021 prices. Now, I want to draw a distinction here, because we are seeing a slight decline in food prices over the last 2 months. Now, it is just barely noticeable, but there's an important thing to remember here, and that is the base effect, because year-over-year inflation numbers measures the change from this time last year. Well, this time last year, food prices were rising dramatically. Now they're barely moving, which means we could actually get a much smaller year-over-year change in food prices. We're going to get a just barely negative month-over-month number, but the year-over-year number could be significantly less than it was last month. And again, look here over the last few months, look at the difference between the red line and the orange line, which is your year-over-year change. The inflation number will be the delta or the change between those two lines. And you can see we had big increases in the orange line this time last year, even though this year's prices are barely moving. So we're going to get a lower year-over-year food number. Now, food accounts for about 14% of the CPI statistics, so food will actually serve to drag down the CPI index that comes out tomorrow. Moving on, let's look at new and used vehicles. And what you're looking at on this chart right here is the Manheim Used Vehicle Value Index. This is my preferred measure for used vehicle prices. And you can see here, again, the base effect is going to play a role here because this time a year ago, used car prices were absolutely skyrocketing. And you can see here in these last 2 months, the price of a used car has actually come down a little bit. Now, month over month, we got this ever so slight uptick for the month of May. So we may actually get a just barely positive month-over-month number in used cars, but the year-over-year number, still positive, is going to be much less positive than it was last month. Now, used cars accounts for about 4% of the index, so this also will serve to bring the CPI number down versus a year ago. And if you look at Manheim's recently published data for the month of May, we actually get some similar data to what we saw last month. Wholesale used vehicle prices increased 0.7% in May from April, so we get a slightly positive number month over month. The Manheim Used Vehicle Value Index rose to 222.7, which was up 9.7% from a year ago. All right, so according to Manheim, we're looking at 9.7% year over year, 0.7% month over month. Going back and looking at the inflation data from last month, we actually had a 22.7% increase year over year and a negative 0.4% month over month. So our month over month used car number is going to come in higher, but wow, a big reduction in the year over year number. That's going to drag CPI lower. And looking at new vehicles, this is off of Kelly's Blue Book. Prices rose 1% month over month and remain elevated compared to a year ago, up 13.5% from May 2021. So according to Kelly's Blue Book, we got 1% month over month for new cars and 13.5% year over year. Well, let's compare that to what we had last month. And last month in new vehicles, we actually had some pretty similar numbers, 13.2% year over year and 1.1% month over month. Now, new cars also counts for about 4% of the index, so we're not really going to see any change in CPI, at least not caused by new cars. Remember, used cars is going to drag the index lower. Now, one of the biggest gains in CPI last month was energy. Remember, we had a 30.3% overall increase in energy and a negative 2.7% month over month. So let's look at some of the more common energy commodities to see what we might get from that. First of all, gasoline. Here's what gasoline prices did over the month of May. I've put these blue arrows here to show you the price at the beginning and the end of the month. Prices started the month of May around $3.36 a gallon and ended the month about $3.91 a gallon. So that's a significant month over month increase in the price of gasoline. Now, if we zoom out on this chart to take a look at where we might be year over year, let's look at where prices were last April, May. You can see back here in last April, prices were around $1.84 a gallon. And then in May, prices had risen to about $2 a gallon. However, the year-over-year difference, the difference in April prices versus April 2021 prices, is going to be smaller than the difference between May of 22 and May of 2021. So the year-over-year gasoline number is going to come up. And gasoline accounts for a little bit under 4% of the index. So gasoline will drive the index higher. Let's look at crude oil. Again, we get about the same thing, a pretty significant month-over-month increase in the price of crude. We started around $104, $105 a barrel. We ended the month around $115 a barrel, and that is a significant increase month-over-month because we were actually down month-over-month for April. Remember, we had that big spike in March that went away in April. Now, looking year-over-year, again, we're going to look at a pretty significant increase because back in April of 2021, oil was down around $63, $64 a barrel. And then in May, it climbed to just over $65, $66 a barrel. Well, now we're at about $121. So we're looking at a significant year-over-year increase in the price of oil. Natural gas, we're getting something similar. The price of natural gas increased over the month of May, starting at around $7.50 per million BTU and ending at around $8.30 per million BTU. So a significant month-over-month increase in the price of natural gas. That's a similar jump to what we saw in April, but let's look at the year-over-year number. And obviously, year-over-year, we are looking at a significantly bigger gain year-over-year than we saw last month. So natural gas, which is a significant input to home energy, which counts for about 4.5% of the index, that's going to drag CPI higher for the month of May. Now look, folks, at risk of sounding like a broken record here, I have to talk about the index for shelter because shelter counts for about a third of the whole index. And in the month of April, we had a 0.5% month-over-month increase and a 5.1% year-over-year increase. Now, the biggest component of this is something called owner's equivalent rent. And I can hear the eyes rolling through the computer screen right now because I talk about this every month. Owner's equivalent rent is a straight up BS statistic. See, owner's equivalent rent is calculated by the Bureau of Labor Statistics picking up the phone and randomly calling homeowners and saying, how much would you rent your home for unfurnished? And the homeowner, without any time to think or any time to look at comparable listings, just shouts out a number, and that's what they report as the increase in rent. Now, that is a very unscientific method, and it does not reflect the reality on the ground. And if you think I'm kidding, take a look at this chart. Now, the source of this chart, this is the Federal Reserve Bank of Atlanta. This is a government statistic. This is the share of income needed to cover housing costs. And look at what this statistic has done over the last 2 years. The percentage of your income that needs to go to cover your cost of housing, i.e. your rent or your mortgage payment, has gone from a low of around 28% to right now almost 39% of your income. That is a massive increase in the amount of your income that goes to cover your rent. So how can we look at a statistic like this and then rectify that with the CPI that is telling us shelter has only gone up by 5% year over year? Because according to this, shelter has gone from 28% to almost 38%. Well, that's an increase of about 30% year over year. One of these things is not like the other. And I've talked about this at great length, that the government is actually incentivized to understate or outright lie about inflation because there are things like veterans benefits, Social Security, raises for government employees. They're all tied to CPI inflation statistics. So by understating the rate of inflation, they can reduce their operating costs by giving people a smaller raise. Meanwhile, the tax revenue from the government continues to go up and up and up because inflation drives higher tax revenue as people make more money in nominal terms. Even though that money doesn't go as far, the government collects more. And when the government's expenditures don't rise at the same rate, the government ends up with more money. Convenient for them, isn't it? So again, I have to throw this out there that owner's equivalent rent is a BS statistic, and it's the main way that the government understates inflation. The actual rate of inflation is closer to 18 or 19% if you go by the way they used to calculate it in the early 1980s. Check out a website called shadowstats.com if you think I'm kidding about that. So when you look at all these numbers in aggregate, where do we think CPI is going to come in? Energy is going to come in a lot higher. Food is going to come in a little bit lower. New cars about flat. Used cars lower. Owner's equivalent rent probably higher, but not nearly high enough. And a lot of the other categories like apparel and recreation, they're probably going to come down because people don't have money to afford those things. So overall, I'm expecting a lower CPI print tomorrow. Now, again, I have to emphasize a lower CPI print does not mean prices have come down. It means prices went up slower. So my very unscientific analysis, based on just a few hours of research, I'm going to say CPI comes in somewhere around 8.1% year over year for the overall number, with core inflation that strips out food and energy coming in at 5.9% year over year. So where do you guys think the inflation numbers are going to come out? Place your bets down below, folks. Let me know where you think core inflation and overall inflation is going to be, why you think it's going to be that way. Let me know what I'm missing. And don't forget to join me tomorrow morning at 8:15 a.m. Eastern Time right here on Nobody Special Finance. I will be live streaming the CPI report. We'll get into the numbers right as they hit the airwaves, and we'll see how the market reacts to that. Until next time, live small and dream big.